Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, I'm Steve Brice, Standard Chartered Bank's Global Chief Investment Officer, and welcome to the third episode of our 2025 Outlook mini-series. Today we're going to focus on equity markets. Obviously, global equities have had a stellar 2024, up over 20% so far this year. So questions are we changing our view on global equities in 2025? Where do we see the opportunities and risks? And to discuss this and more, I'm happy to be joined by Raymond Cheng, our Chief Investment Officer for North Asia. So Raymond, thanks so much for joining me. I guess let's get straight into it. There's a decent amount to cover. So I know everybody's going to be really keen to hear our views on the outlook for US equities. So we've been overweight there, obviously, for a very long time, pretty much for the last 10 years. So looking forward, are you changing your view and are you concerned about elevated valuations?
Hi, Steve. We have indeed upgraded global equities to overweight for the year of 2025 and expect them to continue to outperform bonds and cash. Now, the key driver for equity outperformance remains to be U.S. equities, in our view, where we stay overweight. The President-elect Trump's America First and pro-growth policies, such as deregulation and tax cuts, are expected to add upside to U.S. companies' growth. The expectations of more rate cuts by the Fed in 2025 should be supportive of the valuation. Less restrictive rates, after all, will provide a conducive environment for private consumption and investments. Now, you rightfully pointed out elevated valuations in U.S. equities. Now, we do acknowledge that U.S. equity valuation is not cheap, with MSCI U.S. Index trading at around 22.5 times forward 12-month price to earnings. Now, this is a level that is modestly above the historical average. Following the robust Q3 earnings season, we do observe that projected earnings growth forecasts have been accelerating from below 10% in 2024 to now around 15% year over year in 2025, which should support the valuation levels. Now, also importantly, we view Trump's policy agenda as a catalyst to broaden out the U.S. equity strength beyond the Magnificent Seven names into other areas in year 2025.
Okay, so you referenced there the Trump's policy agenda. I guess everybody's been talking about, probably for 3-4 months now, these Trump trades out there. So maybe you can give us a sense, given the clean sweep of the Republicans, what are the areas within U.S. equities that you favor in 2025?
Yeah, sure. We think the traditional industries will by and large get the most help from the upcoming Trump administration in year 2025. Now, two of the most outsized policy beneficiaries are going to be U.S. small caps and regional banks. Now, starting with small caps, import tariffs imposed by Trump will insulate these U.S. small companies from the more cost-competitive international suppliers. The Russell 2000 index, which is one of the widely used indexes to track U.S. small cap stocks, generates close to 80% of revenues from the U.S. economy. Now, these smaller companies will benefit to a larger degree from the U.S. tax cuts and a soft landing, which is our base case scenario for next year. Now, furthermore, the Fed's rate cutting cycle provides a tailwind as small caps tend to hold more floating rate debt. Now, in the second half of year 2024, we turned positive on the U.S. major banks ahead of the U.S. election. Now with the red sweep, we are expanding our buy call on banks into the regional banks in the U.S. Now, President-elect Trump plans to replace existing leaders of the financial regulatory authorities, including Gary Gensler of SEC, with leaders who are more of a promoter of deregulation. The relaxed bank capital requirements, broadly speaking, would mean bank capital will be freed up to fund more of the growth opportunities domestically. The soft landing backdrop, coupled with declining interest rates, should boost capital markets, investment banking fee, as well as advisory income growth. Now, a steeper yield curve resulting from rate cuts will benefit banks with higher investment yields on fixed rate assets, and those will include loans and securities, given the majority of both large cap and regional bank assets are in fixed rates. Now, while their deposit costs would be trending down, implying a widening of the net interest margin. One key risk for US regional banks is the credit default risk, given the sensitivity to commercial real estate CRE stress. However, regional banks have been reducing their CRE exposure, with almost every bank cutting the related exposures. Another risk is probably investors would be asking if it's too late to get into these two areas. Now, I would use 2 points to alleviate this concern. First, investor positioning in those areas is not crowded yet. Second, using regional bank ETF as an example, current levels are still more than 15% below the historical highs. This means we still see low-hanging fruit there. Now, the other two sectors in the US that we prefer remain to be technology and communication services. Now, these sectors' earnings growth outlook continues to trend higher as AI investments support chipmakers' growth, while AI-enabled applications have accelerated software growth. Now, meanwhile, digital advertising, online entertainment, and AI applications continue to drive robust growth in these two sectors.
Okay, so I think that covers the US. I know we're a little bit concerned about focusing excessively on the US. So, are there any areas to avoid or opportunities to add to elsewhere?
Yeah, let's be clear that while we like US risk assets, we are not suggesting putting all eggs in one US dollar denominated risk asset bucket. Now, we recommend diversifying across sectors within US equities beyond technology, and also suggest diversifying into other regions selectively and opportunistically, in light of valuations and global investor positioning. Within Asia, ex-Japan, we are overweight India. We see the current consolidation as an opportunity to add exposures, or reduce domestic uncertainty following India's state elections in the latter half of 2024, and also as a hedge against any potential flare-up of US-China trade tensions. India's return on equity in general has remained very strong. Also, robust domestic inflows will provide an additional tailwind. Within India, we favor large cap equities over small cap on less demanding valuations. Now, another area of focus is China. While we are neutral in the country, any favorable fiscal stimulus announced by authorities may support fund inflows and revive investor sentiment, leading us to add exposure selectively on pullback. Now, we prefer China onshore equities, A shares, versus their offshore counterparts, as onshore equities are more sensitive to domestic policy surprises. Besides, we continue to prefer high dividend non-financial SOEH shares amid uncertainties in the near term about domestic fiscal stimulus, trust consumption, while awaiting Trump's trade rhetoric. We also favor the Hang Seng Tech exposure because we think that a valuation is attractive, while earnings growth outlook is quite solid there. We expect further policy stimulus to support a recovery in valuation of this index, supported by continued resilient earnings growth outlook and increased stock buyback of these companies. Now, on the other hand, as you said, there are certain areas that we will stay cautious as we head into the year 2025. First, we are underweight South Korea, given the continued domestic political uncertainty following President Yoon's martial law announcement, and the market's heavy reliance on semiconductors that are vulnerable to Trump's trade sanctions. We are also underweight the EU markets, ex-UK equities. The earnings revision index is weak amid lackluster manufacturing activities and Trump's tariff threats. We will closely monitor the political uncertainties in France and Germany, which have weighed on investor sentiment in the region.
Well, thank you, Raymond, for that detailed exposition of our views going for 2025. So maybe just in brief to summarize, so we're overweight global equities, in particular the US. Obviously, that clean sweep and expansionary policies, America first type policies, likely to be positive for equities in the US in particular. We do expect strength in the market to broaden out beyond just tech and communication services. We're overweight those sectors still, but we expect it to broaden out. And at the other end of the scale, we're underweight European ex-UK equities. Obviously, the Trump threats from tariffs and a deteriorating earnings outlook key there. Within Asia, we're neutral on Asia itself, Asia ex-Japan, but we have an overweight on Indian equities within that. So thanks, Raymond, for your time. Thank you, everybody, for listening. The next episode, we'll be talking about the outlook for bond markets in 2025, and I hope to see you then. Please take care.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.